For 5,000 years, one asset has stood apart as the ultimate symbol of wealth and the final refuge in a crisis: gold. It's outlasted empires, survived world wars, and served as the bedrock of global finance for millennia. Its reign has been absolute. But now that reign is being challenged like never before. In this video, we're putting Bitcoin head to head with gold in what we're calling the final battle for your money. Using famed investor Michael Saylor's own framework, we will declare a definitive winner and show you exactly where your money could be safest in the turbulent years ahead. This isn't just another comparison, it's a showdown between the past and the future, the physical and the digital. What's happening in the markets isn't just a bull run, it's a global escape from debasing currencies. And in this escape, there can be only one true sanctuary for your wealth. The question isn't if a new global reserve asset will rise, but what it will be. Is Bitcoin the greatest form of money ever invented, or does gold still hold the crown? The stakes couldn't be higher, because where you place your trust and your capital will shape your financial destiny. So, let's begin the final battle. To know where we're going, you have to know where we've been. And for much of human history, we've placed our trust in gold. Civilizations from ancient Egypt to the Incan Empire prized it for its rarity, beauty, and uncanny durability. It doesn't rust or decay. It is, for all practical purposes, eternal. This physical permanence is gold's first and perhaps most powerful claim to the throne. It's a tangible asset, something you can hold in your hand, immune to the specter of digital failure or network outages. This long history has woven gold into the fabric of our culture and our financial system. While the formal gold standard was severed in 1971, the legacy of that trust endures. In recent years, central banks around the globe have been the biggest buyers of gold, adding it to their reserves as the ultimate backstop against economic turmoil. They aren't stacking Bitcoin in their vaults, they're stacking gold. This institutional backing gives it a level of global acceptance and legitimacy that is, for now, unparalleled. And it's not just bankers. Nearly half of all the gold ever mined is held as jewelry. This provides a massive, constant baseline of demand that exists completely outside of its role as an investment. It has deep cultural and industrial utility, used in everything from electronics to dentistry, giving it a fundamental value that a purely monetary asset lacks. But gold's most famous attribute, the reason investors flock to it in times of fear, is its stability. It's the classic safe haven asset. When markets crash or currencies devalue, gold's performance has been historically predictable. Compared to the wild price swings of newer assets, gold is a sea of tranquility. Its annualized volatility hovers around 15 to 17%, far lower than Bitcoin's, making it the preferred choice for conservative investors who prioritize preserving their capital. In a world defined by uncertainty, gold offers a promise of reliability, a proven track record of weathering any storm. It's a finite resource whose supply can't just be inflated on a whim by a central bank. For thousands of years, this has been enough. Its physicality, its history, its stability, and its universal acceptance have made it the ultimate store of value. It is the king. But the world is changing, and the very qualities that made gold perfect for an analog world might just be its greatest liabilities today. For all its glory, gold is a prisoner of the physical world. And in the 21st century, that prison is starting to look very small. The very thing that gives gold its tangible appeal, its physicality, is also its fundamental weakness. Let's talk about portability, or rather, the lack of it. Imagine you need to move $1 billion of wealth across the planet. With gold, this is a monumental logistical nightmare. You'd need to transport a literal ton of metal. It's bulky, it's heavy, and it requires armored trucks, secure vaults, armed guards, and massive insurance premiums. It's slow, expensive, and full of risk. This makes gold an incredibly inefficient asset for a high-speed global economy. Now, what about divisibility? While you can technically divide gold, it's a clumsy process. You can't easily break off a microscopic piece of your gold bar to buy a cup of coffee. As Michael Saylor points out, it's hard to break off a tenth of your building to buy a car, and the same logic applies to gold. It just doesn't work at the speed or scale of modern commerce. Then there's the issue of verifying it. How do you know that gold bar is real? The risk of fakes, like gold-plated tungsten bars, is a real and persistent threat. To be certain, you need to conduct expensive and time consuming assays, trusting third party verifiers, and introducing another layer of friction. But the most profound weakness, the one that challenges its core identity as a scarce asset, is its supply. We're told gold is scarce, but it is not absolutely scarce. Its supply reliably inflates by about 1.5% to 2% every single year as new mining makes it easier to pull more out of the ground. This means your share of the total gold supply is being diluted year after year. Saylor argues this makes it an imperfect store of value, as its supply isn't truly fixed. Think about that. The total amount of gold is always increasing. We don't even know how much is truly out there. The possibility of a technological breakthrough that floods the market with new supply is a non zero risk. So, while gold was the best we had for 5,000 years, its properties are optimized for a world that no longer exists. It's heavy, slow, and its scarcity is relative, not absolute. The financial system is facing a crisis of confidence, and investors are looking for an escape. Gold has been the traditional lifeboat. But what if that lifeboat is just too slow and too heavy for the digital hurricane we're sailing into? This doubt opens the door for a new contender. All right, we've laid out the case for gold and poked some holes in its armor. Now, we're about to get into the case for Bitcoin. But before we do, I want to hear from you. Based on what you've heard so far, are you team gold or team Bitcoin? Drop your thoughts in the comments below. And if you're getting value from this analysis, do me a favor and hit that like button and subscribe. It really helps the channel. Now, let's get back to it. If gold is analog property, then Bitcoin is its digital successor, engineered to be the perfect store of value for the 21st century. To really get it, we have to stop thinking of it as digital currency and start using Michael Saylor's framework. Bitcoin is digital property. It's not trying to replace your Visa card, it's trying to replace gold. Let's start with its most important feature, absolute scarcity. This is what changes the game. The Bitcoin protocol dictates there will only ever be 21 million coins, not one more. This isn't just a promise. It's enforced by mathematics and a global decentralized network. While it's theoretically possible to change the code, it's considered extremely unlikely as it would require a majority consensus of the entire network. Unlike gold's 2% annual inflation, Bitcoin's new supply is cut in half roughly every 4 years in an event called the halving until it eventually drops to zero. This makes Bitcoin the hardest asset ever created. Next, think of it as digital property. Bitcoin is pure information. It's weightless and borderless. This is where it escapes the friction of the physical world that holds gold captive. Remember moving $1 billion in gold? $1 billion in Bitcoin can be moved in minutes for a small fee to anyone, anywhere on Earth with just an internet connection. You could memorize a 12-word phrase and carry $1 billion in your head across any border, completely undetected. Gold could never offer that level of portability and sovereignty. Because it's digital, it is infinitely divisible. A single Bitcoin can be divided into 100 million Satoshis, allowing it to scale from tiny payments to massive settlements. And its verifiability is instant and absolute. The Bitcoin blockchain is a public, unchangeable ledger. Every transaction can be verified by anyone without trusting a third party. There's no such thing as counterfeit Bitcoin. Some critics point to Bitcoin's energy use as a flaw, but in the Saylor framework, this is a feature, not a bug. That energy is what secures the network. It's the digital equivalent of the vault walls and armed guards protecting physical gold. It's what makes the network so robust that no one has ever successfully attacked it. Finally, Bitcoin is programmable. It's an active, evolving network. New layers like the Lightning Network are being built to handle instant, nearly free transactions. Institutional adoption is exploding, not just through corporate treasuries, but through spot Bitcoin ETFs from the world's largest asset managers like BlackRock. As of late 2025, BlackRock's IBIT fund alone holds over 800,000 BTC, a testament to the surging institutional demand. This institutional embrace is a seismic shift, transforming Bitcoin from a niche asset into a globally recognized one. Bitcoin takes the properties that made gold valuable, scarcity, durability, portability, and verifiability, and improves them by orders of magnitude for a digital world. But let's be honest, presenting Bitcoin as a flawless savior would be irresponsible. The path to becoming a global safe haven asset is full of danger, and every potential investor needs to face these risks head on. The most obvious risk is its infamous volatility. While Bitcoin's volatility has been trending down, it remains significantly more volatile than gold. Price swings of 10% or more in a single day aren't uncommon, and it has seen crashes of over 80% from its peak. For investors looking for stable capital preservation, this can be terrifying. Then there is the world of crypto crime. The decentralized nature of Bitcoin also makes it a target for hackers and scammers. The scale of the problem is staggering. Between January 2024 and September 2025 alone, North Korean actors were estimated to have stolen $2.8 billion in cryptocurrency. In 2024, US victims reported over $5.8 billion in losses to crypto investment fraud. These aren't small time scams, they are industrialized operations. We're seeing AI powered deepfake scams, pig butchering scams, where criminals build long term trust before draining victims' funds, and address poisoning attacks that trick you into sending money to the wrong wallet. What's worse, because blockchain transactions are irreversible, once the funds are gone, recovery is nearly impossible. Beyond digital threats, a terrifying physical risk has emerged: the wrench attack. This is a grim term for criminals using violence or kidnapping to force people to transfer their crypto. As Bitcoin's price has surged, so have reports of these brutal attacks. This highlights a critical security challenge. While Bitcoin is digitally secure, the person holding it is not. Finally, there is regulatory risk. While the landscape is maturing with the approval of ETFs, Bitcoin still exists in a state of evolving regulation. A sudden hostile crackdown in a major economic region could have a significant impact on its price and adoption. You can't just ignore these risks. The decision to invest in Bitcoin is not just a bet on its potential upside, it's an acceptance of its profound and unique dangers. The stage is set. It's time for the final direct comparison using Michael Saylor's framework to declare a winner for each round. Round 1. Scarcity gold is scarce, but not perfectly so. Its supply increases by 1.5 to 2% each year from mining. Bitcoin's scarcity is absolute. Its supply is mathematically fixed at 21 million with a transparent issuance schedule that will eventually stop completely. Winner, Bitcoin round 2. Portability gold is physical and a nightmare to move in large amounts. Bitcoin is digital and weightless. Billions of dollars can be moved across the globe in minutes or even carried in your memory. Winner, Bitcoin. Round 3, divisibility gold is hard to divide for small payments. Bitcoin is divisible to the 100 millionth of a coin, making it suitable for transactions of any size. Winner, Bitcoin. Round 4, verifiability. Gold requires costly third-party experts to prove its authenticity. Bitcoin is verified instantly on its public blockchain by anyone for free. Winner, Bitcoin. Round 5, durability. Gold is exceptionally durable, lasting thousands of years. Bitcoin, as a decentralized network, has proven to be remarkably resilient, with a historical uptime of around 99.98% over its 15-plus year history and 100% uptime since 2013. This is a different but equally robust form of durability. Winner. Tie round 6. Track record and adoption gold has a 5,000-year history and is held by every major central bank. Its institutional and cultural adoption is universal. Bitcoin is a teenager in comparison. While adoption is growing exponentially, it hasn't stood the test of centuries. Winner, gold. Round 7, stability and volatility. Gold is a low volatility asset, making it a reliable safe haven. Bitcoin is a high volatility asset. While this is decreasing as the asset matures, it remains far higher than gold's, making it a riskier choice for conservative investors. Winner, gold. Round 8, sovereignty and censorship. Resistance. Gold stored in a vault can be confiscated. Its physical nature makes it subject to local laws. Bitcoin, when held in self-custody, is truly sovereign. As long as you control your private keys, no government can seize it without your consent. Winner, Bitcoin. The scorecard is clear. Bitcoin wins decisively on the attributes that matter most in a digital globalized world: absolute scarcity, portability, divisibility, verifiability, and sovereignty. Gold wins on its historical track record and current stability, but those are advantages of being the incumbent, not of having a superior design. We began with a question. In the final battle for your money, who wins? Bitcoin or gold? For 5,000 years, gold was the answer. It offered stability and refuge, but we no longer live in an analog age. We live in an age of information, speed, and networks. In this new world, gold's greatest strengths, its physicality, have become its weaknesses. It's slow, expensive to move, and its supply is constantly, if slowly, being diluted. Bitcoin was engineered for this new world. It is digital property for an internet-native economy. Its scarcity is absolute. Its portability is instantaneous. Its verifiability is trustless. It is a truly sovereign asset when held correctly. Based on this attribute by attribute comparison, the conclusion is hard to escape. While gold remains a valuable asset for a conservative portfolio, Bitcoin is the superior store of value for the digital age. It is the evolutionary leap forward. The institutional wave has just begun. The launch of Bitcoin ETFs by firms like BlackRock has opened the floodgates for trillions of dollars, validating its role as digital gold in the eyes of mainstream finance. The decision of where to place your capital is one of the most important you'll make. This isn't about getting rich quick, it's about preserving your wealth against the relentless tide of currency debasement. Money flows where it is treated best. And in the digital age, there is no asset treated better than one that is absolutely scarce, perfectly mobile, and ultimately sovereign. The final battle has been fought, and a new king has been crowned. That's our deep dive into the showdown between Bitcoin and gold. We've declared a winner, but what do you think? Did we get it right? Is Bitcoin truly the future? Or will gold's 5,000-year reign continue? I genuinely want to know what you think, so leave your final verdict in the comments. If this video helped you understand the stakes, please hit the like button, subscribe, and ring that notification bell so you don't miss our next breakdown. And as always, remember this is for educational purposes and is not financial advice. Do your own research and make decisions based on your own financial situation. Thanks for watching.